Hi, Bill Hayes here with Kenilworth Asset Management, and today we're going to talk about income. I'm actually going to call this Income Part 1. What we're going to do is we're going to talk about ways to how do you generate income when bond yields are basically done. You've got the 2-year at roughly 0.25, you've got the 10-year trading at 1.48. So how do you put your money in, look for ways to keep it safe and get some income for yourself? Well, what we're going to talk about today is something called exchange traded funds, or ETFs. ETFs have really come into their own, and probably in the last 5 years. What an ETF is it's an index or a mutual fund with much less expenses. So what you get is you get all the opportunity of a mutual fund, which is kind of like a basket, without all the expenses of a mutual fund. And there are two ETFs that we're going to talk about today that if you use this, you can build almost a synthetic bond portfolio. And we're going to talk about two. One is called LQD and one is called TIP, TIP. Now the LQD is an ETF that trades investment grade corporate bonds. Now personally, I am a big believer in corporate bonds right now because one, their corporations are sitting on a lot of cash right now. They can go to the market and refinance at really low rates. And three, if you look at all of what's going on in the world, municipalities and governments, they're all hurting for cash, not corporate America. Corporate America is sitting on a lot of cash. So with LQD, you get a 4% dividend yield. Not bad. And what you have is you have a basket of investment grade corporate bonds. See, that's the other thing I like, is because if you're thinking about it, I mean, not to say that Microsoft, all your money in Microsoft bonds, or if you look at GE bonds or J&J bonds, that's fine. But why have all of your eggs in one basket? Although what Will Rogers said, put all your eggs in one basket and then watch the basket. Well, I kind of like the more diversified approach. And what LQD does, it gives me this nice pooled approach to corporate bonds. Now, if I were to have this, I would take about 70% of my money and put it into this. The remaining 30%, I would put into TIPS, or Treasury Inflation Protected Notes. And what a TIP is, it's a treasury bond that also will ratchet up as inflation goes up. Now, what you have, currently the yield on that's about 2.1. What do you have with a TIP? Well, what you have with a TIP is the best of kind of both worlds. You have the treasuries, which is a security of the United States government, plus you have inflation protection. And with interest rates as low as they are, and frankly, what's going on with the hot summer and the crop damage that we've got going on, my fear, this is just me speaking, but my fear is you can see some inflation coming down the road because food prices are going to go up. Food prices are going to go up, could put a lot of pressure on inflation. So by using these tips, you now have an opportunity to save yourself and capture, not have to worry about what could happen due to inflation. So here's a little bond portfolio, 70% LQD, 30% in TIPS, and now you've got a nice little bond portfolio you've wrapped up, and it's a great way to utilize ETFs or exchange traded funds, get a good rate of return, and keep your expenses down. For more information, you can always call me, Bill Hayes, at Kenilworth Asset Management. The number is 847-920-0400. Thanks, and have a great day.